Good morning. This is Joe Gomes, Senior Analyst at Noble Capital, covering ACCO brands. This morning we'll be doing something a little different. Rather than a full company presentation, Boris Elisman, CEO of ACCO, and myself will be holding a fireside chat. Unfortunately, we won't see any flames behind us, but we'll work through that here. Audience members can still forward any questions for Boris by clicking on the lower right corner of the video window. With that, I'd like to introduce Boris Elisman of ACCO Brands. Good morning, Boris, and thanks for taking the time to sit down with us today.
Good morning, Joe, and good morning, everybody at the Noble Capital Markets Conference. Happy to be here this morning and looking forward to our conversations without the fire.
So, real briefly, let me just give the audience a little description here. ACCO Brands is a designer, marketer, and manufacturer of recognized consumer and end-user demanded brands used in businesses, schools, and homes. That's a long way of saying if you've ever worked in an office, if you ever went to school, if you've ever done projects at your house, you have used ACCO products. Some of their brands include At a Glance, calendars, Swingline, staplers, 5-star notebooks. So you might not know the name ACCO, but you know their brands. In 2019, the company generated just shy of $2 billion of revenues. Today, it's a $825 million market cap company with a dividend yield of 2.9%. Extremely well-diversified company, both through products, geographic, and customers. Their top 12 brands represent some $1.5 billion of revenues, and in their are the number one or number two products in their key brands. So Boris, I'm going to start it off here. If you could talk a little bit more about this diversification on both the product, the geographic, and customer side.
Sure, Joe. We've been pursuing for several years a strategy to diversify and really with the purpose of strengthening, improving, and de-risking our business. And we've been doing that both organically and through acquisition. So let me just give you some examples of product diversification. Organically, we've introduced a line of air purifiers under TrueSense brand last year, 2019, and had a phenomenal launch of the products and a phenomenal 2020. We think that over a fairly short period of time, this could become a $100 million product line for us. Through an example of the acquisition-led diversification, we just closed the acquisition of PowerA in December. That adds to us a line of video gaming accessories. If you look at geographic diversification, we've been focused on strengthening our position in emerging markets where the demographics are a little bit more favorable to our types of products, and made some acquisitions and increased organic growth in Latin America and also in continental Europe, where we've been relatively weak. And then if you look from a channel perspective, we've been focused more on the consumer-led channels. So that includes both e-tail and mass channels. So if you put that all together, as a result of this diversification activity, we are a faster growing, more profitable, stronger, more resilient company, more immune to the shocks that may come in one industry or one particular market.
Great. Now, I'm going to come back to TrueSense and PowerA here, but I think some of the the misperception of the company is that, you're dependent upon the office space, the office product superstores, and in truth, that continues to be a smaller and smaller percentage of the business, especially the office superstores. Could you just kind of talk to us about, what percentage of your business now goes through the office superstores, and maybe highlight some of the other channels in which you've been growing much faster?
Sure. If I look at our latest annual information of 2019, about 18% of our sales went through all kinds of office superstores. That doesn't include just Staples, Office Depot, and Office Max, but it also includes their counterparts around the world. For 2020, I certainly expect that number to be much lower than that 18%. Office superstores have different dynamics in different countries around the world, but if you look at what probably our listeners are most familiar with, if you look at the U.S. And specifically Staples, Office Depot, and Office Max, that channel has been shrinking in the U.S. For several years. Their consumers been going to other channels. If it's a small business consumer, a small business customer has been going more to online purchases. And if you look at true consumers, they've been going both to online and to mass merchant channels such as Walmart and Target. So we have a channel strategy that is agnostic to which channel the consumer prefers to buy. We want to be in all the channels where a user wants to shop. So as a result of that, we've been really pursuing a strategy of growing through e-tail and growing through to mass. So e-tail is no surprise, is our fastest growing channel. It did really well in 2019 and accelerated its growth in 2020. And that's not just the U.S. phenomenon. It's really doing well across the world. And mass is our second biggest channel. Our biggest channel is independent dealers, independent technology dealers and wholesalers. That's about high 30s, 40% of our sales. Mass is our second biggest channel and also doing really, really well.
Thanks for that insight, Boris. And just kind of a follow-up there, obviously in the news lately has been the Staples, Office Depot, or ODP, news on Staples potentially looking to acquire Office Depot. How would you see that if that were to occur? And obviously we understand that's not a given. How do you see that, impacting ACCO?
Yeah, I mean, the latest, again, our viewers may be familiar, the latest scenario is Staples made a bid for all of ODP. ODP rebuffed the bid, but said they may consider selling them the retail arm of ODP. So, retail is a smaller part of the business for us. So if that were to happen, it would probably mean that they would close a few more stores than they originally planned. If you look at the footprint of Staples and Office Depot, Office Max, they have slightly over 2,000 stores in the U.S. They've been closing about 150 or so per year. That's kind of our assumption going forward as well. So, maybe that would accelerate that to a few more store closures. Overall, we already are planning for a scenario where our sales to office superstores in the U.S. will decline at a rate of roughly 7% per year. And this may make it a little bit worse, but I don't think it's going to be too meaningful given the small size that Office Depot retail represents for us.
Okay, thank you for that. Now, ACCO, one of the things as I looked at the company always impressed me was, the continuous productivity improvements in the annual cost savings that you're able to drive from those. Maybe you could fill in a little bit more about how you accomplish these, and how much more of this is there available to do. What's your goal for your annual savings from these productivity enhancements?
Sure, and thanks for that compliment. We have a very robust program based on Lean and Six Sigma at ACCO Brands. From a legacy ACCO standpoint, we've implemented it back in 2010, so it's pretty mature at this point. And if you look at when we acquired the Acelte business in Europe, they had a Lean program that they've implemented in their factories go back to 2004, 2005 timeframe. So we have a very robust, very mature global program that seeks to generate around 2% of COGS in savings every year. That translates to $20 to $30 million a year. Much of which we reinvest back in the business, but some goes to the bottom line as well. It's hundreds of projects, literally hundreds of projects that we track on a quarterly basis. They span from supply chain consolidation to DC relayout to robotics automation projects. So we look at everything and anything that can deliver savings to the company, and we know, given that no matter how you slice it, we're going to be a fairly slow growth company. We need to generate productivity savings in order to drive profit improvements in the company. So it's a focus for us.
Right, and I would think that also plays into, I believe, in many of your products, your biggest competitor is private label. How do you go about combating, private label and being able to justify, your price points vis-a-vis private label?
That's exactly right. We most often compete with private label, our customers' private label as the alternative. The biggest way is really to build in the consumer demanded features into the product so that the customer is willing to pay a little bit more to buy our products, our brands, rather than a no frills private label product. And if you think about it, most of our products are relatively inexpensive. So asking somebody to pay 50 cents or $1 more for a brand that they trust, or quality that they know, or a feature set that meets their needs is not too much for most customers. So that's I'd say the primary strategy. And the other alternative is also to offer low cost but good quality products to our independent dealers who have a choice of buying our brand versus somebody else's private label as they try to meet the needs of their customers and try to hit the price points that they need to hit in order to win a deal. And we've done that with, for example, expanding our line of meat products to cover main high velocity products, mainstream price points, so that our dealers have that choice and buy from us other than go and source their own private label.
Continue along the theme of the cost of products and efficiencies. When the past couple of years, and we've had these China trade issues, let's call them, going on. I know you along with a lot of other companies, moved what you could in the manufacturing side out of China to try and lessen your being exposed to the tariffs. Kind of where are you standing today? How much of your production is U.S. based versus in China or maybe in some of these other countries that might actually have given you a lower cost of manufacturing?
Yeah, we've shifted much of what we could shift out of China. Not so much to the U.S. because U.S. is still very much a high-cost country of manufacturing, but to other countries in Asia, primarily Vietnam and Taiwan. So we have a nice balance between some products that we still make in China, but a lot of products that we make in Vietnam and Taiwan. If you look at our global footprint, about 50% of our products we manufacture ourselves in the countries where we actually sell. In the US, the number is around 40%. In Europe, the number is around 60%. We manufacture in Europe, so it really depends on the categories. And then the other 50% globally, we manufacture, we import it into the country, primarily from Asia. That's a nice balance to have. It helps us manage capacities, it helps us manage costs, and it helps us manage tariffs and duties that countries impose here and there.
Let's shift back here for a second to TrueSense. As you mentioned, relatively new product. It's in an adjacency. It helps to expand your total addressable market. I guess one thing, let's kind of talk about, how does that product, given what we've come through here in the pandemic, and that's an air filtration product, has that helped with some of the demand for that product? Are there other, brand extensions of the key TrueSense product out there that you guys are looking at that might be introducing here in the near future?
Yeah, we're incredibly pleased with TrueSense. As you may realize, it's obviously very difficult to launch a new brand in a brand new category. So we were intent on doing well, but never in our wildest dreams did we expect that we will be able to ramp up as quickly as we did with TrueSense. It has done phenomenally well, and clearly, to your point, the issues that the world has experienced with the pandemic certainly helped drive the demand. There were many times during last year, when we were out of stock and we could not meet demand, just given the lead times for manufacturing and an incredibly quick ramp up. We're getting better. The business is very balanced globally. We have a strong business in the US, a strong business in Europe, and also a strong business in Australia and Asia as well. I mentioned that we have expectations that we're going to reach to $100 million plus in the next couple of years with TrueSense. And we're not going to do that just in the air purifier category, although we're going to expand that to different price points and different duty cycle capabilities. We're going to be introducing commercial grade air purifiers, as well as further expanding the consumer line of products. But we're also going to be moving to other areas of wellness still under the TrueSense brand that will further drive the penetration. Things like humidifiers and such are key adjacencies to the air purifier line with TrueSense.
Excellent. And we'll circle back again here to PowerA. I mean, just the potential game-changing type of acquisition in terms of new product category. I think it gets you into some more distribution channels that you had previously not been in. It gives you the opportunity to take that brand into channels that you were in. Can you just talk a little bit about the PowerA, some of the strategic rationale as you were looking at it that drove that acquisition, and maybe where we should anticipate you taking that here in the near future?
Sure, Joe. We've been looking at expanding into adjacencies for a long time, probably for the last 5 years or so, but just we're not able to find something that met our strategic intent as well as made financial sense for our shareholders. We've been introduced to PowerA very early in 2020 before the pandemic started. We met the team. We started talking to them, and the more we talked, the more we looked, the more we found out about the company, the more we liked what they could offer us. It's a large, attractive market. It's fast growing. It has favorable demographics. It has great financials. They have high market share, and it has opportunity for further growth. If you look at the market itself, and this is not even counting the growth spur we're going to see because of the introduction of the new consoles, but if you look at historically, this is the market that's been growing roughly at 12, 13% per year. And if you look at opportunities for us to accelerate that growth, it's really in Europe, expanding to continental Europe, where we have fantastic distribution, and we think we can leverage our infrastructure there to grow in Europe. It's moving into mobile gaming, really gaming on your smartphones. PowerA has a good strategy to try to approach that market. It's expanding to other gaming accessory categories such as headsets. I think there's an opportunity for PowerA to grow there. And then we also have opportunities to grow with PowerA in Asia and in Australia. So we think, given their track record, their strong market position, the favorable tailwinds that the market has, and then the ACCO brand stewardship, we think we can take that business, which is already very successful, to another level. And then it's a platform for other acquisitions for us. We're not done with that. We still believe we want to reshape our company to be more consumer facing, and PowerA and gaming, video gaming presents another leg to that stool and allows us to grow the company through acquisitions along those lines.
Now, with the PowerA acquisition, obviously, historically, one of your key businesses has been back to school, which is a pretty seasonal business. Would PowerA help offset some of that seasonality, or is the PowerA business also a pretty seasonal business?
PowerA business is pretty seasonal business. It's skewed more towards Q4, whereas North American back to school is skewed towards primarily Q2, a little bit into Q3. So it does offset the North American seasonality, but it is still a seasonal business. You can imagine there's a lot of gifting that goes on with PowerA products around Christmas time. So Q4 is a big season for that.
Okay, and we got a question here from the audience, kind of dovetails into the next question I was going to have. Is, acquisitions have played a key role in driving company growth and diversification here recently. And the question is ACCO considering any more acquisitions in 21 and 22, or is it more 21 going to be more digesting, PowerA and getting that, integrated as best as you can in the ACCO umbrella before you start looking at more?
Yeah, 21, we're going to really focus on integrating PowerA and paying down debt. Those are going to be the priorities. If there's a small tuck-in acquisition, and I'm talking about small, we certainly would take a look at that and maybe do it. But nothing. I don't really anticipate anything meaningful in 21. But we think that come 22, we'll be in a position to do more things to continue to move our business towards consumer But I said 21, it's really focused on integrating PowerA and pay down debt.
So let's go along on that path for a second. Management's identified, 4 key uses for free cash flow: dividends, debt pay down, acquisitions, and buybacks. Can you speak to each of those, and where do you see the bulk of free cash flow going over the next couple of years?
Sure. We generate over $100 million in free cash flow every year. About 25 million of that goes towards dividend, and certainly I expect that we will continue to pay dividend and fund dividends, so 25 will go towards that. The second priority, and really I think the remaining priority for 2021, is to pay down debt and delever the business. Never say never, but I really don't anticipate share repurchases in 21 as we try to delever the business. But if there's a opportunity, we'll take a look at that. The priority is to delever, and then acquisitions come when they come. As I mentioned, in the near term, it's unlikely that we're going to do anything, but longer term, we think with our ability to delever the business, we'll have enough free cash flow to fund future acquisitions as well.
Okay, thanks for the insight on that. And you've put out in the past some goals for margins on your gross margin and SG&A as a percent of sales. Can you tell us where we are in those today, and how you think you can get to what the goals are?
Sure. Our long-term goal is to have gross margins between 33 and 34%, and to have SG&A in the roughly 18.5 to 19% range. We certainly will take a step back in 2020 due to the pandemic and the reduction that we will see in revenue and fixed cost deleverage as a result of that. So we still have a couple of years to get to the desired level of gross margins. PowerA will certainly help. They are gross margin accretive for our business. I certainly expect gross margins to improve in the next couple of years versus 2020. Not sure we'll get to that 33 or 34% range, but we should be on our path there. From an SG&A perspective, we do an excellent job managing expenses through a bunch of programs that we just discussed, and we're very disciplined when it comes to investing. So I think as long as the revenue will be there, we will definitely make our 18.5 to 19.5% or 19% in a fairly short period of time. So those are still the right goals for us, for our company. Again, 2020 will be a step back for all the understandable reasons, but I expect 21 to be an improvement.
And what do you see as the biggest challenges here in the near term for the company?
Well, in the near term, I still expect the first half of the year to be fairly difficult, kind of a continuation to what we saw in Q3 and Q4. I'm not counting on short-term, near-term changes. So just continuing to manage the business in a difficult environment will be our priority. I do expect that in the second half, the economies will recover. I expect that in 2021, students will go back to physical in-class schooling, which will obviously drive demand for our types of products. So I do expect a recovery in the second half of 21, which will drive growth. The focus of the company is profitable growth. And to continue to reorient our business towards faster growing categories, faster growing channels, make the right investments in products to drive that growth, and make sure that we manage for profit those things that are declining, or we're selling or discontinuing those things that are declining to allow us to continue to invest in profitable growth.
So that kind of that goes into my next question for you, Boris. Can you kind of give us your view of the current marketplace trends, where you see the market going in the future, and how ACCO can profit from any of these changes?
Sure. So as I mentioned, the environment today is the same as the environment was in Q4. And as I mentioned, we're seeing that kind of continuing at least for the next several months. Hopefully, Q2 will be an inflection point, and we'll see a much stronger recovery in the second half of the year. If you look at us, we are very well positioned with our portfolio now for that recovery. If you look at how we spend our time, other than sleeping when we don't use anybody's products, but if you look at how most of us spend our time at work, studying or playing, we have products that will benefit from whatever happens in any of those three areas. So if I look at work, for example, our expectation is that post-pandemic, many businesses will go to a hybrid environment where they will alternate between working from home and working in the office. And given our portfolio, we certainly have a very strong portfolio for the office, but we're also have an increasingly growing portfolio of products, and we're investing in products that could be used for work from home. So as the business world goes hybrid, we will benefit from that shift. If you look at studying, I certainly expect that schools will go to physical in schooling in 2021. We tried to do the remote schooling this last year. The world tried to do this remote schooling last year. And I think there's a global consensus that having kids in physical school is a lot better for everyone concerned. So certainly my expectation is that in 2021, we will go back to physical school, and that's going to drive demand for our products. And then the final area, which is what we do during our leisure activities or play, we have, with PowerA, we have a significant presence in the play category. So I certainly don't expect people to be doing less video gaming, even as they do go back to working in the offices. So we think we will continue to benefit from them. So, I think the company is positioned very well for the upcoming recovery, but until that time, we need to manage the difficult environment.
Fantastic. I'm gonna throw it back to you, Boris, for 1 second or 1 minute. Anything that we haven't covered so far that you think, hey, you want to get out there about ACCO?
I think we've talked about most things, Joe. I just wanted to remind our viewers that over the last few years, ACCO Brands has really shifted and has shifted to become more of a consumer-focused company as opposed to an office-focused company. With the PowerA acquisition, over 50% of our products will be consumer, school, and technology products. Commercial products, office products will be a minority of our sales. Our growth in our orientation is towards consumer. Some of these declining legacy channels that we talked about are less impactful on our business. Broader economy and broader macro issues still are, but things that are more industry specific become less and less impactful. We generate very, very strong free cash flow. We're in a good financial position. So I would encourage your viewers to take a look at us as an investment.
Well, Boris, I think it's time for me to throw another log on the fire behind me. I really do want to thank you for taking the time. This has been fantastic. I think, as you said, people need to be aware of, the new, in quotes, ACCO, that it's not your parents' ACCO. Great speaking with you. We look forward to watching the investment story unfold going forward. And thanks again, Boris. Really appreciate it.
Thank you, Joe. I appreciate it too. Thank you.
Have a great day.
Thanks.